of a certain age, that phrase should trigger a smile and maybe a little nostalgia. You're probably seeing that granny from the old Wendy's commercial holding up a tiny burger and asking that question. It still rings true today. Where's the beef? Thank you, Wendy's. You gave us a cultural classic and a market metaphor that still slaps. Back then, beef was cheap, fast food was fun, and clean eating wasn't even a twinkle in anyone's eye. Today, beef prices have gone up a staggering 180% since 2007, and nearly 64% since just 2020. That's a 9% annualized gain. For ground chuck? You can call that inflation on a bun. If the commercial ran today, the old lady would be asking, "Where's the Fed?" The chart of beef prices is ugly, no way around it. And before the Fed thinks about taking a victory lap on taming inflation, let's get one thing straight. This has nothing to do with tariffs. Beef inflation is supply and input driven. Herds are smaller because of drought, and feed costs have spiked because of fertilizer costs that blew up after the war in Ukraine. That's not a monetary policy problem, it's a climate and commodity problem. And yet, the Fed keeps holding rates higher for longer as if that's going to magically make hamburgers cheaper. Maybe if consumers get so squeezed by high borrowing costs that they stop buying burgers, Wendy's will cut prices. But then what? Lower prices mean lower margins, layoffs, and stock pressure. The cure becomes the disease. That's not theory, that's economics in real time. If Wendy's tries to preserve its 62% gross margins by shrinking burgers, those same grannies from the commercial would be back in front of the cameras and they would be rioting. Shrinkflation is not a strategy, it's a warning label.